Hello everybody, it's Fung here again. Today we'll be talking about annuities, and again the information here is sourced from the book The Truth About Money by Rick Ellerman. So getting started, what are annuities, right? Well, they are streams of income much like pensions and social security, right? In the commercial marketplace where we're going to get them, you get your annuities from insurance companies, right? They're the issuers. So essentially you just give the insurer your investment and they're going to give you money in return. So the most simple example is the immediate annuities, where you give the insurer your age and how much you plan to invest, and then they're going to pay you monthly for the rest of your life. Now there's a lot of downsides to annuities, okay, so let's get started. The first downside is that the insurer always makes money. They're going to expect the worst case scenario from themselves, like you living a very long time or the investment having low returns. So that means they're always going to profit off of you and they'll always give you the lowest number possible for them, right? So the solution to this problem is to find an offer that's enough for your needs and to just accept the fact that they're going to profit off of you. The second downside is that there's an income guarantee and it's only as strong as the insurance company, right? So if the insurance company goes bankrupt, there goes your annuities. So the solution here is to just choose a company that is known for its safety. So the third downside is that your decision is irrevocable. So once you give them your money, you can't get it back, okay? So it's really illiquid here. So the solution is to just make sure you have cash reserves. So if you're going to need money for emergencies, you're going to have money, right? Don't rely on this for your emergency cash. So number 4 on the downsides is that your income won't rise. So the income does not scale with inflation. And then that means that in 23.5 years, the income is effectively cut in half. Remember that with a 3% annual inflation, which is the average, right? And that means in 23.5 years, your money is essentially cut in half of its value. So the solution here is to invest into other assets to offset this impact of inflation. The fifth downside is that the income stops upon death. So the insurer is going to keep all your money when you die. The solution here is just to choose a different payment schedule. There's a joint life and survivor where basically they keep on providing you income as long as you have another person or yourself is alive. And there's the period certain where it guarantees income paid for a minimum amount of years essentially, even after death. So we'll talk about now deferred annuities, where the income generation is delayed. You don't have to annuitize right away, and you can withdraw occasionally instead if you want to get your money. So in this case, the money grows tax deferred so that you won't pay taxes unless withdrawn. That's what tax deferral means. So the appeal right now to these annuities, right, is that you have a guaranteed income and that there's tax deferred growth. That's the appeal of them. So now let's talk about the different types of deferred annuities. First are the variable annuities, where the returns earned they vary based on the investment's performance, right? And the investment in this case is the sub-account, which is essentially something that just mimics a fund. So in this case, it is possible to lose money, right? Because your investment could go down. And that's why they have guarantees offered, right? You can have either the income guarantee, the principal guarantee, and then there's the death benefit. So let's get started with the income guarantee. This is where your income stream is based on the original investment. So it could be anywhere from like 5% to 7% of the investment per year. So for example, if you invest $100,000 and you have a 5% guarantee of income, that means that you're going to be paid $5,000 for 20 years, right? That's because 5,000 times 20 is 100,000, right? Your initial investment. So even if this investment value goes all the way down to zero, you're still going to get paid all the way up to 100,000. So in the case where your investment goes up, actually, the period extends beyond 20 years, right? It's more than just 20 years. And actually the income that you receive will increase based off of what the investment value is now. And this updates roughly every 5 years. So next is the principal guarantee, where this is essentially where your original investment is guaranteed. So as long as you don't withdraw it within 10 years, you get your original principal investment, right? So if the investment goes up, that means the guarantee is going to go up too. And this updates like every 5-ish years, similar to how the income guarantee worked. So it's easier to invest into something risky now because your principal is not at risk. So putting this into an example, if your investment were to rise and then your investment initially, right? It's going to be guaranteed here because that's your initial investment. Then if it were to rise, then that's where the new guarantee is at now, right? So even if it goes down, you're still guaranteed this now, right? And it can only go up. It cannot go down. So it makes something, investing into something risky easier in a sense. So the third Guarantee is the death benefit, and this is where your beneficiaries are paid the higher of the two of either what you invested minus the withdrawals or the current value of the investment. So these are pretty good because that means you can just pass on your wealth right to the next generation or whoever. And just keep in mind that this only matters when you die, right? So just keep that in mind. So there are drawbacks to the variable annuities, even though they're a better annuity. And this is that the guarantees come at a cost, right? You pay for them in fees, which we're going to talk about on the next slide. And if the insurer goes bankrupt, your benefits become worthless, but the money that you invested is given back at least. So let's talk about the expenses. There's the annual contract fee, the annual mortality charge, the annual living benefits, and the annual expense ratio and the SAI charges. So this means that the total expenses are 3 to 4% annually, which is higher than mutual funds and ETFs. And this is just the trade-off, right, for the tax deferrals and the performance guarantees of annuities. So next we're going to be talking about fixed annuities, where, as the name implies, they have a fixed rate of return. These are considered as insurance products, so that means you don't get anything back when the insurer goes broke, right? Remember with the other one that we just talked about, the variable ones, if the insurer goes broke, at least you get your initial investment back, right? But in this case, you don't get anything back. That's because they are insurance products. Next are the equity index annuities, where the interest rates are related to the stock market, basically. So if the stock price rises, the interest rates rise as well. And the last one is the bonus annuities, where they offer like a 1 to 5% bonus on your principal. And the con here is that they have lower interest rates, longer surrender periods, and higher surrender fees, right? They have to compensate for giving you that bonus. So now we learned about the different types of annuities. We're going to talk about the taxes on them. So annuities are not taxed every year, but there's a 10% tax if you withdraw them before the age of 59.5 years old. And liquidating annuities or receiving income excess to the amount that you invested will be taxed as ordinary income, which is your tax bracket. So this tax is higher than the taxes on capital gains and dividends. So for example, if you invested $10,000, right? And then now you're starting to make money that's beyond that $10,000, like you're starting to profit off of it, right? That is now being taxed as ordinary income, which is going to hurt you a lot. So, and remember that the tax break is deferred, not exempt at death, right? So that means your heirs will have to pay taxes on the profits that you earned in your annuity. Somebody has to pay the taxes on it eventually, right? So transferring annuities is actually pretty simple. With Section 1035 exchange, basically there's tax-free exchanges between annuities. So the assets, though, is under the condition that the assets must be transferred from one insurance company to another directly. All you have to do is sign a form that's available from your annuity carrier, and you might have to pay withdrawal fees or lose your death benefit from your annuity if you want to transfer them. So recapping everything that we learned, right? Annuities are just streams of income like pensions and Social Security. The pros are the performance guarantees and the tax-deferred growth, but there are several drawbacks and cons to these annuities, right? So yes, they do have a legitimate role as an investment, but they are rarely the best choice. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. You guys are not obligated to do so. And I'll catch you guys in the next one. Peace.